You can stay. Okay, I'm starting now. Okay, guys, we are just 2 days away. Tomorrow's our last day of tutoring. Tomorrow is basically all topics, any topic. We'll do some multiple choice practice. We'll do some FRQ practice. So I recommend also coming tomorrow. I will be reviewing all day in class on Wednesday. Remember, our test is at noon. From what I know, it's in the Lego gym. So what is that? It's in the Lego gym. So what does that mean to you guys?
It means like don't get to leave early.
Warm clothes, dress in layers. Short sleeve, sweater, scarf, maybe a hoodie or two. A down jacket.
A blanket.
Yes. 5 blankets. 1 electric piece.
That's not realistic.
Okay. And do not use a highlighter on the test. And test is at noon, in case I forgot to say. Oh, also, everyone, we're taking a lunch on Wednesday. I don't know if you know that. I don't see half of you. But we are taking a lunch on Wednesday. So whatever lunch you have, forget that for Wednesday. You go straight from 4th period to lunch. Tomorrow is the last day I'm taking money for pizza. So there's 8 slices of people.
8 slices of people?
8 people worth of slices. I've only ordered 8 slices.
Yeah, you can just say that.
One pizza, but it's split between 3 people. You know what I meant. Okay, so we're talking about monetary policy today.
Miss Taylor,
So,
I need a pen. Do you have one?
you don't have a pen.
These all don't work.
Then throw them away. Don't put them back in your bag.
They have like a little bit of things, but like it doesn't show up.
That doesn't work. So go throw them away and go to Office Depot or Target or Walmart or Walgreens or wherever you like on the way home and buy some blue or black ink pens. I have a pencil.
Well, I have that.
Okay, let's see where we are for monetary policy. Turn to, I think it's like 4 pages in at the very top. It says the financial sector, money, and monetary policy. Woo. Okay. We're going to start on the right-hand side of the page because that's easy and I can get to it quickly. Do you need it? Yes. Anybody else need the thing that I'm holding in my hand? Play. Anybody have this? Okay, get that play on your way back. Okay. I was telling her how I took Judy at the Federal Reserve. No, the one next to it with all the checkboxes. Yeah. You just shut up. Be quiet.
Which one?
That one. Okay, turn it's like 4 pages in. At the very top, it says financial sector, money, and monetary policy. We're talking about the 3 functions of money. Okay, 3 functions of money. If you remember correctly, that day I gave you like a little snippet to read, and it's like one of 3. Unit of account is 1.
Which one is this?
Exchanging.
That says account. Do what? Store value.
Medium of exchange.
Yes.
I said that.
You did.
I said exchanging thingamabob.
That's not the same thing.
Okay. You don't need to be talking. Sit. 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 All right. Money can be anything as long as it's all 3 of those functions. So a unit of account, does anyone remember what that means?
You can tell the value of something.
To compare things.
Let's not use the word value because that's something else.
To compare.
Okay, so you're putting it in the same unit, like a unit of measurement, so you can compare prices. So use to compare prices. But like if I say, oh, this shirt is like
2 goats.
2 goats or a half of a cow, I don't know what is cheaper or what's more expensive. And so if we put it into like, oh, it's $5 or $2, then it's like, oh, I know that $2 is less. Do DJ, you don't have to like have everything that comes in your head out of your mouth. Store of value. I get it that you're saying right things, but you're also saying a lot of like other things between those right things. So just keep that to a minimum. What does store of value mean? Money can
Depreciate.
It's
No.
kind of constant.
it keeps its value over time. Yes, I know that $10 in the future is not going to be worth as much because of inflation, but it's not like you put like $10 in your pocket and then like 5 years later you reach into that pocket and it's like depreciated to like $8.75 on it. No, it's still $10. So you can keep it and store it because you're saving. If you are saving your money for future purchases, then that is going to be a store of value. And the medium of exchange means to buy things. Okay, unit of account used to compare prices. Store of value, you can save it and it'll keep its value over time. And medium of exchange, you can buy things with it. It says just two types of money on the like box underneath it, but technically it's 3 types. I don't know where the other one is. There are ways that money can get its value. So what is like backing money?
Gold.
Well, depends on if it has one of these 3 things. It only has 2 on there. It says commodity. It should be somewhere in the middle, should be representative and then fiat. So number 1 is commodity. Meaning even if the money did not have value, it still could be used for other things. So like even if we didn't use cows as money, we can still use cows for other things. We can eat them, we can wear them, we can milk them, we can make them like pull plows. I don't know what a cow can do.
They can harvest it for their flesh.
You can harvest it for their flesh. I'm pretty sure just I said that, but in a less graphic way. But basically it has intrinsic value. It has intrinsic value. And what intrinsic means that it means it comes from within. So the value of a horse comes from like within the horse, or a value of gold or value of spices. No one assigns the value. It just always has value. Representative, which is not on here, means the money doesn't have value, but it holds the place of a commodity that does have value. So the gold standard. Gold itself would be commodity. If we use like shillings of gold, then that would be a commodity. But if we have the gold standard where paper money represents the gold, like there's gold stock somewhere in a bank and every dollar bill printed is backed by gold, then that's where it would be represented. The gold standard, the silver standard.
Like Fort Knox.
Yeah, we have Fort Knox still. We don't have the gold standard anymore, but we have Fort Knox just in case of a rainy day where we would need to go back on the gold standard, but there's not a single country in the world that has the gold standard left. I'm sure there may be some tribes somewhere that maybe have commodity where they like barter, or they might have like shells or something, but they're not going to have representative. And last one is fiat, which means the government backs the money, and the money is federally insured by the government up to what, $250,000 per account, like checking account. Your money in like the stock market is not
So if you
federally
were
insured.
incredibly rich, you want to split up all your money between $250.
Yes. If you're smart, you're not going to put millions of dollars in one account. That would be dumb. Okay, but your money is backed by the government, backed by Gov. Does anyone know what is it called with the insurance? What type of insurance that is on money? There's 4 letters. FDIC. Does anyone know what that stands for?
Federal.
Deposit Insurance Incorporated.
Yes, Federal Depository Insurance Corporation. That's the fiat idea. Okay, so let's go to the money market graph with the underneath that box. We have, what's on the y-axis for money market? Devin, are you sure?
Yes, it says right there.
Oh, it does? Oh, man, look at you using context clues. Nominal interest rate, quantity of money. What does money supply look like, Adrian? Is it vertical?
Yeah.
It is. Yes. Money demand is downward sloping. All demand curves are downward sloping. And then where they intersect is our equilibriums. Why is money supply vertical?
There's no correlation between nominal interest rates and quantity of money.
There's no correlation between nominal interest rate and like that's a set amount. Like this quantity of money is like $17 trillion, 538 million, blah blah blah, and cents. Like that's an actual amount. It does not vary with the nominal interest rate. That's how much is in circulation. There's no more. There's no less. Unless they use some type of monetary policy, which is exactly what shifts money supply. So it's shifted by the buying and selling of bonds. When the Federal Reserve, the central bank, buys and sells bonds. By central bank. I'm saying central bank today because usually I say the Fed, but a lot of people on the mock test were like, so does the central bank in this question, did they mean the Fed? Yes. I don't know if I've stressed that enough, but yes. So shifted by the central banks buying and selling of bonds. What's another way to say bond? Open market operation or securities. All of those, you could just fill in the word for bond. So underneath where it says shifters of money supply in that box, I said shifters of money supply.
Just say it slowly every time.
Context clues, people. Context clues. Obviously, the shifters of money supply. If money supply shifts to the right, what did the Fed do to make that happen? They bought bonds from the bank. Okay, money supply to. They bought bonds from the bank. So this is buy bonds. If money supply decreases and shifts to the right, that must mean that money. That what, Clay?
Just Jay Sean over here.
I know you were dancing. Yay! You know what's better than Chick-fil-A? College credit.
I know. I don't know. College credit has to.
Yeah, they must have sold bonds, sell bonds. That was the answer I was looking for. Okay. Changing the required reserve ratio and changing the discount rate, which are the other tools of monetary policy we'll get to today, do not shift money supply the way that bonds does, which is why buying and selling bonds is the #1 tool of monetary policy. But going back up, we're kind of like making a little circle for the demand of money and shifters of money demand. I'm just going to redraw my graph. Nominal interest rate, quantity of money, money supply, money demand. Okay. I guess we can go to the demand for money box instead of the shifters. So there are 2 reasons why money demand is downward sloping and is kind of in this box. So you need to know the shifters of money demand, but you also need to know why there's a negative relationship between the nominal interest rate and the quantity of money. So it's downward sloping. So that means when nominal interest rates go up, what happens to the quantity of money? It goes down because they're inversely related. They're negatively related. When nominal interest rates goes up, the quantity of money goes down and vice versa. When interest rates fall, quantity of money goes up. Does anyone remember what transaction demand for money is? Or asset demand for money? At this point, I'll be happy with either of these.
It's like if you're buying stuff, transaction demand goes up.
If you're buying stuff, you're using money. You have demand for transactions.
Yeah.
Okay. What's an asset then? What's the other way money can be used for?
High interest rates, you want to save it.
Okay, so if interest rates are, let's say, fall from this interest rate to this interest rates fell, and you went from like this quantity to like this more quantity. Interest rates fall, Cole. What's happening to your savings account?
I'm not getting as much return on it.
Okay, so do you demand money for assets or for transactions if your interest rates fall?
For transactions.
So there will be more money in circulation for what now? for transactions. But if interest rates go up from like this point to this point, and you are now, there's going to be less quantity of money in circulation, and you now are demanding money for what?
Asset.
Because it's earning a higher interest, and we're talking about an asset being a savings account. Does that make sense?
Yes.
Okay, so the transaction demand for money is like needing money for transactions versus asset demand for money, wanting money in your savings account. And then it just restated the relationship between those two things. If interest rates goes up, the quantity of money demanded goes down. They're inversely related, they're negatively related. And when interest rates go down, the quantity of money demanded goes up. Okay, so what shifts money demand? Money demand shifts. Last year's FRQ?
Aggregate demand.
No, it's eco.
No. What?
It's aggregate demand that shifts money demand.
Explain.
Well, say like investment goes down and a part of like real GDP, your demand's gonna shift to the left.
Okay, so we have this other alternate graph over here, price level, Y, aggregate demand, short run, aggregate supply, long run, aggregate supply. So you just said investment spending went down for whatever reason. Aggregate demand falls. What gap does this create, Courtney?
What gap does that create?
Yes.
Recessionary?
Yes. Okay, when GDP falls, it's a recession. There's GDP falling, prices fall in a recession, there's less spending, it's a recession. And it's like, oh, well, the government should like buy bonds and expand money supply and blah, blah, blah. But even if it doesn't do that, monetary policy will happen accidentally. And the idea of money demand shifts, like shifters of money demand, it's only really one thing, but it's in general automatic monetary policy. Monetary policy will happen without the central bank or the Fed doing anything. But that box underneath where they're shifting money supply to the left and to the right with buying and selling bonds, that's discretionary. So if you had this, the buying and selling bonds, this is discretionary monetary policy. I can get through red state without getting sick. Okay. So, Brendan, back to what you were saying. We're in a recession. Go. People are spending less.
Yes, ma'am.
How does that affect money demand?
So people are spending less. Eventually, interest rates will fall.
Why? What's shifting? Which direction?
Short run,
What do you
aggregate
demand?
demand.
Do you demand money right now, Brendan?
No,
Why not? What are you not doing?
not like at a store buying stuff.
And this is not at a store buying stuff. You're in a recession, no one's buying, spending is falling, aggregate demand decreases, and no one's spending, they don't need money. And so money demand shifts to the left, money demand too. And look, interest rates naturally go down. And that will boost the economy back to long-run equilibrium. So they can either buy and sell bonds. The central bank can either buy and sell bonds to regulate interest rates, or if they do nothing, they don't do any bond or purchase or anything like that. What?
The policy shift.
It's not no policy shift. Okay. I just want to make one thing clear. There is, let's see if I can say this and hopefully people like understand. So here's what I'm gonna do. I want your thumbs up, and as I'm talking, if you're getting me, you keep it up. As you're not understanding me, you bring it down, okay? So I can know where I start losing people. If I'm gonna say hopefully no. There we go. Congress and the Federal Reserve.
That's why I took
Congress and the Federal Reserve. Okay. Congress and the Federal Reserve have lots of different options if there's a recession or inflation. Congress can do fiscal policy. They can either decide to raise or lower taxes or raise or lower government spending. Okay. That's discretionary fiscal policy. They're making a choice to do fiscal policy. But even if they did nothing, taxes and government spending would still change. If it's in a recession, there's going to be more people in welfare. That's more government spending right there.
People will lower tax brackets.
And people will fall into lower tax brackets, and that's a tax cut right there. The government didn't make that happen. That just naturally happened. Okay. So that's discretionary and automatic fiscal policy. They either choose to change taxes and government spending or it just naturally changes. Monetary policy works the same way. They can discretionarily decide to buy and sell bonds, or if they don't buy and sell bonds, money demand will increase and decrease based on inflation or recession to change the interest rate, which is monetary policy. It's just automatic monetary policy. I haven't lost any thumbs. Okay, I lost a thumb. Adrian?
I guess you just.
Did you like go away for a second and then come back and you realize you were lost? Which part?
You said when you started talking about
Monetary policy? They bought and sell bonds on purpose. You don't accidentally buy a bond. I see no thumbs. I need thumbs. Okay, no, I see your thumb. I get, no, it's fine. That way I understand. Okay. Like the central bank, they purposely buy and sell bonds to stimulate and control the economy. Yes? But even if they decide to buy and sell no bonds, like they change their bond spending and selling, and no way. If you spend less money, you demand less money, and that naturally lowers the interest rate. So even though they didn't buy or sell bonds, interest rates are naturally going to change with aggregate demand. And that right there is automatic monetary policy. So we have automatic fiscal, discretionary fiscal, automatic monetary, discretionary monetary. But then there's one more thing, that they've done none of these things. They've changed taxes and government spending, not at all. There's no change of interest at all. There's nothing. It'll say like no government policy change. And then you know that they're bringing out option number 5. And that is wages. We're in a recession. What naturally happens to prices in a recession? They go down. Prices is an input price.
What?
Just kidding.
What?
Whoa.
You lost me there.
That's because I didn't say words that made any sense. Let me try that again. What happens to prices during a recession? They fall. What's the price of you? A wage. And if the prices of everything, including you, fall, Megan, and wages fall, wages is going to be a shifter of what? Aggregate supply. And if wages fall in a recession, what happens to aggregate supply?
Shifts to the right.
It increases just to the right because you can produce more if your input prices are cheaper. So here's what that looks like. No policy. There's no space for this because we're supposed to be talking about monetary policy today, but there's a few more new faces in here, and I do want to make sure I cover this.
Miss Taylor, can I use the bathroom?
You're in tutoring.
I still felt like I needed to ask.
No.
Okay, God.
You know, in college, you don't raise your hand in college. There, I'll save you a lot of social anxiety your first day of school in college when you're like, oh God, I've never died. and then yeah, just go. No one's gonna stop you because you're paid to be there. Oh no, we're in a recession. Shut up, Devin. Aggregate demand too. Oh no, the government has done no policy, discretionarily or automatically, fiscal or monetary, Congress or the central bank. Whatever will I do? Wages to the rescue. Hey, you're being paid less. Prices fall, prices of you fall, wages fall. Wages, as a supplier, that's what I pay my employees. I don't have to pay them as much. I can hire more of them. Short run, average supply increases in the long run. I know it's the long run because we're on the long run. Prices don't fall again, but at least you're back in equilibrium. Hooray.
But if prices keep falling, that means wages keep falling.
DJ, come on, man.
Does that mean it shifts even further?
No. No.
It balances itself out.
It balances. You're on the long run. It shifts to the long run because you're in the long run. On the long run, you're in the long run.
Wait, so you're on the long run?
Uh-huh.
The aggregate supply.
No. There was a recession, and aggregate supply fixed it. But remember, no policy shifts aggregate supply. Policies, fiscal and monetary, shift aggregate demand. But there's not a single policy out there, and that's the point. No policy shifts aggregate supply. No policy shifts aggregate supply. Policy shifts aggregate demand. No
So
policy
there's
shifts aggregate
absolutely no way any government could shift aggregate supply.
That's why stagflation is so bad, because stagflation is a shift to the left of aggregate supply. And the only tools at their disposal are taxes, government spending, and interest rates, and that shifts aggregate demand, not aggregate supply.
Will it always shift it back to equilibrium with no policy?
Close enough.
On your test on Wednesday, yes.
In real life?
Who the hell knows? This is all like theory.
We just do this?
This is theory.
Wouldn't that
So
happen
theoretically, a government cannot shift aggregate supply.
No policy.
Theoretically speaking.
Theoretically. Yes.
Theoretically.
That's all we go off of is theory. Okay.
Because reality sucks.
So let's see here. It says money market practice at the bottom. This is decent. We can look at this. It says unexpected inflation causes the demand for money too. And I want you to talk to this with someone next to you. Unexpected inflation. Bam, prices are higher than you expected. What do you think money demand will do? Talk to people next to you.
Which means your demand for assets.
Hey,
That's true. I'm trying to connect us all together here.
Han,
Yes.
prices
Yes.
skyrocket unexpectedly. Do you need more or less money? Who would say less to that? If prices go up unexpectedly, why would you say that you need less money? Things are so more expensive. Good thing I'm poor. No, like that doesn't make any sense. If like inflation is high, you'll demand more money, and what happens to interest rates? They go up, and that's the thing we just talked about. It'll actually fix that inflation. If interest rates are too high, aggregate demand will fall, and the inflation that you just were worried about is no longer a problem because aggregate demand just shifted to the left.
Demand for the money will increase in inflation.
Demand for money will increase in inflation and decrease in a recession, yes.
And therefore, an interest rate will increase.
During an inflation, yes. Okay, how are we on that? I need to see thumbs. Because as soon as I was like, talk to someone next to you, I heard the word decrease all around the room, and I almost died inside.
Almost.
No, I did, a little bit, but
Muscle.
don't let them see you cry.
Because remember, inflation means the prices
Are,
going up.
yes, I taught
And therefore,
someone something.
You want more money to buy the goods, which are more expensive.
Yes, Justin, fantastic.
Give that man a sticker.
No,
Okay.
okay, Adrian, number 2, if the supply of money increase, and you could draw it or you can think of it in your head, if the supply of money increase, the interest rate will, and what now? What? Let's see how wrong he is. Supply of money, I said increase. Oh, that's to the right. Okay.
Yes.
Adrian, if the supply of money increased, the interest rate will. Say that one more time. He said decreased. Now. And investment spending will.
I'll go up. It'll go up because
Children, if you're not drawing graphs on almost every single thing on the test on Wednesday, that's right, Wednesday, you will probably get a 2 on the test. And because I don't get ones. Aaron, investment spending is a shifter of what? Okay, so go with your gut instinct and then say the exact opposite of what your gut says.
Damn.
That's rough. Hit the target. That's rough.
Well, there's 4 shifters of aggregate demand, and there's 5 shifters of aggregate supply. Unfortunately, there's an I in both of those. So which one do you think? Do you think it's aggregate demand or aggregate supply? Hooray! Okay. If interest rates are lower, Brianna, if interest rates are lower, what does that mean for a typical business person?
They can invest.
What does that
Or
mean?
They can take out a loan.
They can take out a loan and buy more pizza ovens and pizza. And aggregate demand shifts to the right, raising both price level and GDP. But let me take this one step further than this is asking. Oh my gosh, this whole like buying bonds, which lowered interest rates, put us in an inflationary gap. Oh no, but did you know that when aggregate demand shifts to the right and you're spending more things, your demand for money also increases? Oh my God, what? And here we are, our new interest rate, which is higher. Oh no, and then we'll go back here and nothing matters because it's all the same. You lost it. Thank you. Thank you. Well, I did the whole business cycle there. As in like, we're fine, we're totally not fine, now we're back to being okay again.
That's good.
I'm flipping to the next page. Holy God, why is there so much stuff on here? How's everybody doing at home? You good? You good? Okay.
Hey, I would like to provide 2 triangles of carbohydrates based upon the fermented milk of the cow.
And sliced different meat particles of pigs and such.
Yes, the protein flesh of various meat.
Thank you.
Yikes, you don't like
I was going to
Okay.
say something, but I couldn't figure it out.
We're on the next page. This is Justin. 2 slices of Justin.
Now you have 2
Oh my God. Okay. Let's go through this quickly. It says, what's the Federal Reserve and what does it do? It is the central bank of the United States. And what does it do? It does 2 things. Actually, it does a whole bunch of things. But let me give you a couple things that it does. No one's writing this down. Okay. Thing that it does, number 1, it controls money supply. It's probably its biggest job because that's monetary policy. Thing number 2, it's a bank's bank. What does that mean? Can you put it like money there? No. But Wells Fargo and Chase, they keep their money there along with the government. So it's not only a bank's bank, it's the government's bank. Thing number 3, did you know that they're the lender of last resort? If banks need a loan, they're going to go to the Fed, but only as a last resort. They much rather pay the federal funds rate, which is from their friendly banks, than the daddy discount rate, which is from the Federal Reserve. And thing number next, because I lost count. 4. Thing number 4, they clear checks. The routing number at the bottom of your check also has the number not only of just your checking account, but your check number, but the routing number, which says which regional bank headquarters to send your check to, so the check can be transferred from one account to another. How many Federal Reserve districts are there?
9, 12.
12. Okay, what is the money multiplier equation in the next box?
Oh, it's 1 over RR.
1 over the required reserve ratio, 1 over RRR. Okay, we'll get back to that. I want to go down. I want to get like the boxes where we can easily answer. Where it says federal funds rate. The federal funds rate is the rate that is the rate of interest that banks charge each other. It's the interest rate that banks charge each other. And that is their friendly federal funds rate, the FFR. Where does it say discount rate? It doesn't. Okay, cool.
No.
Okay, write it on the bottom. The discount rate is the interest rate that the federal bank charges. If you were to go to the lender of last resort, aka the Fed, and ask for a loan, because no one else gives you a loan, oh, by the way, you're totally a bank in this scenario, then you'll be paying the discount rate, which is the interest rate that the Fed charges. Okay, bonds, just scooting over. It just says bonds, what is maturity? Maturity is whenever the bond is up and like can be cashed out. Maturity can range wait, hold on. The range. I want to say 1 year to 30 years. It could be 5 to 30 though, but 30-ish years. Okay, in that same box, bond prices and the interest rates. How are they related? Inversely. So it says if the interest rates decrease, bond prices will arrow up. If the interest rate decreases, bond prices will arrow down because they're inversely related, also called negative. Did I say it backwards?
Yeah.
Well, thank you for correcting me. Interest rates decrease, bond prices will arrow up. I said arrow up, didn't I?
So interest rate increase, bond price
decrease.
You said if the interest rates increase, then it'll arrow up.
It's fine. It's fine. It's fine.
So it's an inverse relationship?
It's an inverse relationship. Sorry.
You got it.
Okay, what do I want to do next? Okay, let's go back up to money multiplier practice. Okay, they say discount rate here. Okay. Money multiplier practice. It says assume the reserve requirement is 0.1. The Federal Reserve buys $10 million worth of bonds. The money supply will blank by blank. So that first blank is going to be an increase or decrease. That second blank will be a number. Keep in mind, I want you to work on this on your own. I'm going to just write some things to remember here. For expansionary monetary policy and contractionary monetary policy. Expansionary, they will buy bonds. They will lower the discount rate and they'll lower the required reserve ratio. Contractionary is just the opposite, sell bonds, raise the required reserve ratio, and raise the discount rate. People with OCD are going to be really bothered that I flipped those two, but whatever. And what you do with this is the bonds, like a change in excess reserves, times that money multiplier is going to give us our like max change in money supply. So let's do the first one together, and then I'm going to give you a couple minutes to work on your own. It says assume there's a requirement is 0.1. The Federal Reserve buys bonds. Oh, it's buying bonds. Increases money supply. These decrease money supply. Oh, what am I doing? Money supply.
I don't know.
What?
Literal sphere.
I'm a teacher.
That's what I said.
Like teacher school day one.
So you want to be a teacher?
Actually, no. I did not go to teacher school at all. So, the 10 billion times a money multiplier, which is 1 over RR. It gives you the RR in the problem, 1 over 0.1. What is 1 over 0.1, Clay?
100.
Try that again.
10 times 10.
Oh, you were giving me the answer here?
Yeah.
Yes, 1 over 0.1 is 10, so it's going to be 10 times 10, which is $100 billion.
I'm confused. Why is it
Would
times
it be
10?
90?
That's the money multiplier. So it's change in excess reserves, which is the amount of the buying of bonds, which is 10 billion. The money multiplier, remember, M is 1 over RRR. It said the RR in the problem was 0.1, 1 over 0.1, which is 10. So then it's 10 times 10. Megan.
Do you know whether to multiply it by the excess reserves versus the total reserves?
Okay, good question that I will answer in 1 minute or 2 minutes after you do these. How to
I
go?
like this, a multiplier, like if I put discount rate, like if you change it.
Would the money multiplier affect the discount rate? No.
Oh, with the discount rate, you change the multiplier.
No. Only the required reserve ratio would change the money multiplier. Changing that. Okay, so I'm giving you some time to work 1 through 5, 2 through 5, whatever.
On money multiplier practice.
On money multiplier practice. Clay, you have a face. Andrew, you also have a face. Here?
Yeah.
The formula or this? Change in excess reserves times M, which is the money multiplier, it gives you your max change in money supply. Like,
Is there like a difference between when you ask us to 100 million versus 90 million?
yes, and that's what Megan just asked. And this doesn't apply to these questions right here, but I'm about to. As soon as y'all are done, I'm going to tell you when that you'll see a difference.
I think you only do that whenever they're changing this deposit.
Yes.
Because this is the bonds.
Gonna give you 1 more minute, and then I will tell you the answers.
So if you want to expand
Like my shirt? It's new. I got it at Target. It's either 17 or 12. I remember it was like, oh, that's 2 more than I thought it would be. So I thought it was maybe 10 or 15. I was like, that's clever. Because it's just like, it's a different number. I don't know. Okay, here we go. For the money multiplier practice. I just have the answers. Okay, number 1 we did together, which was increased by $100 billion. Number 2 is decreased by $50 billion because the money multiplier is going to be 1 over 0.2, which is 5. Number 3 is increased by 50 billion because it's just less bond value. Number 4 is decreased by 10 billion. And number 5 is decreased by 8 billion because the money multiplier there is 4. Okay, now the question was, when am I going to multiply all of the excess reserves times the money multiplier or all of like deposits? Well, it just depends on what the question is asking. And this is going to be probably like a bank balance sheet type of question, which is like an FRQ, which I'm really planning on a bank balance sheet FRQ. I would not be surprised at all. But you just take a picture? Okay. So, if it says max change in money supply, then it's excess reserves times the money multiplier. It gives you that. But if it says max change in banking system, well, the banking system includes all the reserves, what's in excess and what's in required reserves. The amount of money in money supply can only be what you loan out from excess reserves, which is why it's excess reserves. But max change in banking system is the deposit times the money multiplier. Because the entire deposit is in the bank. It's split up into excess and required reserves, but it's all of the deposit that's in the bank. It's just split up. But money supply, it's only what can be loaned out, which is in excess reserves. So if you had a scenario where it's just like, Courtney deposits, I don't know, $100 in her checking account. And the RRR is 20%. Well, first, the money multiplier, you figure it out right away because that's easy. 1 over 0.2, which for those of you that haven't done this in a while, you move the decimal place over 1. That 1 becomes a 10, that 0.2 becomes a 2, then it's just 10 divided by 2, which is 5. Well, what times 5? If I say, what's the change in the money supply? Well, you can't loan out all 100 of her dollars. You can only loan out 80% of that because the other 20% of that is staying in the bank in required reserves. So it would be 80, which is 80% of 100, times 5. So it's a total change of what, $400? Is that right? $400 in the money supply, but the entire deposit is going to be in the banking system, and so then it'll be $100 times 5, and that's going to give you $500. $500 in the banking system, $400 in money supply. So it's always going to be less than money supply because you can't loan it all out. Questions, comments, thoughts, ideas, or concerns? Hopes, dreams? Threes are higher. Threes are higher. Okay. All right. Shifter practice next. No, I'm not going to waste my time with that. It's literally the table that I just drew. Okay, good. Let's do the interest rate and inflation, which if you look at the questions there, what equation are you using? The Fisher equation. Okay. The Fisher equation. The Fisher equation can be written one of two ways. It is either nominal interest rate minus expected inflation equals real interest rate, or real interest rate plus expected inflation equals nominal interest rate. And someone years ago said, well, I always think of it like this. It's like N with a little I like that. So nominal has inflation in it. If you were to take out inflation, you get real. If you add inflation to it, oh my God, no God, if you have real and then you add inflation to it, you have nominal.
Wait.
What?
Okay, wait, hold on.
It's a shape. It looks like an N.
I was really confused because I wasn't sure what that was.
This one?
I didn't know what you were writing.
Wait, whoa.
Is that better? No. Okay, it's not like times. Okay. So let's see what it says on number 1. It says if the nominal interest rate is 7% and the expected rate of inflation is 3%, what is the real interest rate? 4%. 7 minus 3 is 4. Okay, Devin, if the real interest rate is -2, the real is -2, and the nominal interest rate was 3. What is the expected inflation rate?
What?
Yes, 5%. Whatever.
You didn't think I could do it.
Oh, and then it says nominal equals and real equals. It's just asking for definitions here, I'm pretty sure. So the no. Santiago?
So nominal has inflation, but it is not adjusted for inflation.
It is not adjusted, meaning if there's been inflation, it has it in there. If there's been deflation, then it has the deflation in there, which is why it's not all that accurate because it has not been adjusted for inflation. If you wanted to make what is it with the real growth, then you convert it into real, then you adjust it, and then you convert it into nominal. Real. Okay.
Yeah, it's just like the wording is weird.
So, if you were to define nominal interest rate, it would just be like interest rate not adjusted for inflation, and then real is adjusted for inflation. And does anyone remember, and I said this once, the very first day when we talked about real and nominal, there is two C words that both mean, well, one means real and one means nominal. And?
Capital.
Yes. Which one is which? Current?
Current real.
Sorry. 50, so disappointed. Current is another way to say nominal, and constant is another way to say real. If you see constant dollar prices, just know that that's code for real. If you see current value of something, that's code for nominal. Right, Justin?
I was not listening to you.
That's why I picked on you. It's a teaching technique.
Yes, yes.
Is it?
It is.
I have not changed myself. What was your previous question and the background surrounding it?
Justin, I've missed you in my class.
I know you.
Okay.
Oh, and your husband will not be available on the 23rd.
Is he going on a date? I'm so
With Justin.
No.
Date is a strong.
That is.
I will also be not available as I am going with Megan.
Good.
Yes. So far, just Megan and me. Nobody else.
I'd take you, but I'm not in top 10%.
Okay.
Wait, so you can act like multiple PS?
Yeah. There's not enough teachers to go around.
Yeah, I was kind of disappointed because I was like, I don't know who to ask.
Yeah, you have to ask like right away, and don't be like, well, I only want to take one person. Well, then you're gonna like.
Yeah. I
Yeah.
want to be like,
Like Mr. Youngblood always takes 5 because there's a table of 6. So he's a table of his people.
What?
Last year I took 3. It's not a big deal at all.
He's so popular. I thought you could only take one for one guest.
No,
No.
you can take one guest. I can take as many people as one, and then if many people invite me.
So technically, you're not taking that.
Wait, are you?
They're taking me.
You're being taken by a bunch of people.
Yes. What?
Do you sit with like
She just.
Yes, you sit with your teacher. Hopefully you invite someone that you like, as opposed to like now it's just awkward that I'm sitting with someone that I have nothing, like I can't talk to.
Yeah, but I mean, I'm the only one that's going to
Oh. That's awkward. Okay. So you're saying you're not inviting me, Cynthia. Okay, moving on. Bank balance sheets. Let's do the right side first. It says define demand deposits. Does anyone know another way to say demand deposits?
Where is this?
Right here, where it says define demand deposits.
Yes.
No pressure.
Wait, I can.
It's in M1, or sorry, M1 is in it. No, it's in M1. You said it right the first time.
Yeah.
It's in M1. You could also call it a checking account. It's a check. It's
I don't know what the other
deposits.
Yeah.
okay.
Deposit?
Yeah. Owner's equity. This is the whole like T-chart thing with assets and liabilities. Owner's equity is your assets minus liabilities. I saw an AP test question just a couple years ago. It literally said bank or it said like bank XYZ has $100 million in assets and $80 million in liabilities. How much is it worth? And then it was all like 100, 180, 20, or like
50.
50.
Negative.
Or negative 20. Yeah, and so it's just assets minus liabilities is your net worth. There's 20. Okay, 20 million or whatever it was. Going over, I'm gonna go up and then like down and then up. So it says define excess reserves. Excess reserves actually has a formula. I don't know if you know this. It is total reserves minus required reserves is excess reserves. That's obvious. You add all of the reserves together, you take away the required, whatever is left over is excess. Good. Fractional reserve banking basically just means that a bank only has a fraction of the deposits in the bank at all times. Like we've done T-shirts before with like assets and liabilities, and there's like 100 million here, and they have like 20 1,000 or something in required reserves, and then the other about they like loan out, or there's bonds, or there's excess reserves, whatever. It's like fractional deposit reserve, which means that only a fraction of deposits are kept in reserves. That's all that means. That there's a required reserve ratio, and it's not 100%. It's a fraction, 20%, 10%, 5%, whatever, that will be kept in the bank at all time. Okay. We got some bank balance sheet practice. And then one last page. But one last page is just graphs.
Want me to get it from you?
No, I'll do it. Okay. It says on the bottom here, if the reserve requirement ratio is 0.1 or 10%, how much of this bank's required in what? Oh, haha. I'll say, how do you figure that out? You're using this over here. That's okay. Use the bank balance sheet to answer the questions. Got it. So this is basically like an FRQ. So what's that? In an itty bitty little space. We have a bank balance sheet with assets and liabilities. I'm going to just rewrite it. Oh, my husband's birthday is this Thursday. If y'all wanted to wish him happy birthday.
I've never met your husband.
This Thursday.
It's his 40th birthday. Big 4-0. 4-0. Big married to a 40-year-old.
That's weird because you're like 21, right?
I know. Like,
That's gross.
I mean, I just turned 21, like yesterday. So. Oh, by the way, if you see this term, T-bonds. Just, no, treasury bonds. But they're the same as any, like, we didn't cover T-bonds. We only covered bonds. Where do you think the bonds come from? The Treasury of the United States. But not Mr. T. Mrs. T. Okay. Demand deposits.
Demand.
20,000.
Demand deposit.
Okay. Okay, number one. Santiago. If the reserve requirement is 10%, how much of this bank's required? Wait, no. How much of this bank's? How much is this bank's required in excess reserves? Notice how it says total reserves of $5,000, but the required reserve ratio is 10%. 10% of what number? Not 50,000. Only whatever is in deposits. So RR is only a fraction of this number. If the RR is 10%, what is the fraction? What is the amount?
2,000.
2,000 is in required reserves. Well, excess total reserves is 5,000. So of that 5,000, how much of it is required? How much of it is required? How much of it is excess? Okay. So total reserves has both excess and required. Required reserves of that number is $2,000 because that is 10% of $20,000. It's only whatever is in demand deposits, which is what the required reserve ratio is based off of. Excess reserves is 3,000. Question? It's not from anywhere. That number, that 5,000. Notice, look what it says, total reserves. It doesn't say excess. It doesn't say required. So that means it's both in that $5,000 number. So it says that the required reserve ratio is 10%. 10% of what number? Which is?
Oh, okay.
Okay, which is 20,000, right?
Yeah.
But I said 10% of it is required reserve. So 10% of 20,000 is?
10,000. I don't know how to do it.
2,000. You drop a zero. Sweetie. For 10% of anything, you just move the decimal place over one. And so, Han.
Yep.
Stay with me.
Okay.
Let's start over.
Okay.
10% of what number is required reserves?
20,000.
And 10% of 20,000 is?
2,000.
So 2,000 of this total reserves is required. The other 3,000 left over to make up the total of 5,000 must be excess.
So that's not coming from the 20,000?
Technically it is, but it doesn't matter.
The rest of the 20,000.
Okay, can I explain this? Everyone, whatever you're doing, I don't know what you're writing, you're on your phone, you're doodling on my board, I don't know, you have nothing else. You're giggling about something probably not important, and Brianna is now just taking pictures. Okay. Demand. Can I walk you through this bank balance sheet?
Yes.
Not the question, just the bank balance sheet itself.
Yes.
This bank opened up, and 20,000 people, no, each deposited $1. No, someone deposited $20,000 into this bank. You know what they did with it? They gave 15,000 of that 20,000 in loans, which that's how much? 5,000.
Yes. Wait, I'm so confused.
Where did that bond come from?
What is the topic?
I don't know, it just came from somewhere. They're on equity. It's just like appeared. No one knows. I'm so confused.
This is just, this is that.
Yeah. Ah, yeah.
They have a bond.
So
This
where's
was
the
there.
equity? It just came
It's just there.
They have an
Okay.
unbreakable bond.
I'll take more.
Adrian, stop talking. You don't know your shifts. Han, you don't know math. Okay. Let's go through this list and figure out who doesn't know what. Okay. Number 2, what is the maximum possible increase in the money supply if the bank loaned out all of its excess reserves? How do you figure this math out? And what is excess reserves?
3,000.
What is the money multiplier?
10.
1 over 0.1, which is 10. So 3,000 times 10. And Han, what is 3,000 times 10? Because you said you don't know math.
30,000.
30,000. Assume that a customer deposits $5,000 into the bank. What is the initial change of money supply? Well, I hate that question. Is it $5,000 in cash? Because if it was $5,000 in cash, and let's assume because there's a dollar sign that's in cash, what happens to money supply?
No change.
No change, because both demand deposits and cash are both in M1, and that is what money supply is. Right, Luis?
Yes.
What are you doing?
No change. How about the
Okay.
Both in M1.
Yes. Number 4. Oh, God. Who said wait?
Because they're both in M1, so you're just moving it from one.
So the reason that it doesn't shift anything is because it's physical cash.
Yes.
If it was a check, it would have shifted.
No.
No, because
Notice how it says initially?
Oh, okay, yeah.
Initially, before you loan it out again, it just the first initial impact is doesn't change M1. In the long run, it will because you'll like multiply it out and loan it out. But the first initial thing is money supply does not change because they're both M1. If it went from savings, to deposits, then M1 goes up. And so money supply would go up initially and in the long run because of the money multiplier.
I need to go over M1.
I think we're about to because I don't see it anywhere on here, yet it's a big thing. And number 4, if the $5,000 deposit is placed in reserves, how much is demand deposit, how much is excess? So $5,000, this goes to $25,000.
Yeah.
Where am I getting this? Number 4.
Those charts to the right. Oh, like, okay. So 25 is
Okay, Shayla, we just put $5,000 in the checking account. How much will required reserves go up by?
500.
Are you sure?
Because you get the required reserve ratio. You multiply it by the 5,000, right?
What?
What?
1 times 5,000 is 500.
Yeah.
Knock off a 0.
It's just 10% of 25,000.
Oh. Well, yeah.
It's 10% of whatever's in demand deposits. Demand deposits went up to 25,000. So instead of just 2,000 in required reserves, it'll be 2,500 in required reserves because it's 10% of 25,000, which is about 500. It feels like someone said 500 and then Shayla said 500, and she didn't know why. She just said it because she heard someone say it, and that's informational social influence. Psychology, people.
That stuff's on my head.
Okay. What about excess reserves? It changes by
The rest of it.
the rest of it. So if we had 25,
4,500.
thank you. And then number 5 is over here. You see it?
No, it's not.
It changes by 4,000.
It changes by 4,500.
7,500.
From 3,000 to 7,500.
I was adding.
Yeah, it's. Yeah, it's girl, she said, I want.
Wait, look, I didn't
Back.
hear
How would we say that?
Do you have a diploma that has the word economics on it? Because I do, framed in my house on the wall of my office.
Does it say
Where's
that? Yeah, it says it's not.
Oh.
It also says Texas Tech.
Why are some of y'all going to Texas Tech?
You just roasted
People have
everyone
heard of
watching
my
that.
school.
All 2 people
Hey,
watching that.
Number 5. No one's watching. No one's giving me thumbs up. I'm getting roasted. Someone called the fire department. Okay, number 5. Assuming that a customer draws $1,500. Okay, if there's a bank balance sheet problem, number 5 will be asked. If someone withdraws $15,000 and they don't have $15,000 in excess reserves to give them, how do they get this money? They can borrow from other banks. They can call in the loans. Well, actually, it literally says, other than asking borrowers to pay back their loans, which they'll say on FRQ, or they can borrow money from the Fed, or they can sell their bond. They have a bond here. Of course, if your FRQ has bank balance sheets and they don't have a bond, don't say that because they don't have a bond to sell. But this one does. And look, it even has equity. Like, they could sell some furniture or something. I don't know. There's no space for M1, M2, and M3. So make some somewhere.
Wait, why is equity in the
It's
liability?
It's just
Wait,
that's where you put it.
That's-
But owner's equity is like the net worth, right?
Yes.
So why is that in liability?
It's not okay. Technically, it is assets, liabilities, and net worth. But we've never dealt with net worth in many of our problems, so most people just do assets and liabilities, and net worth is implied.
Okay.
Yeah.
Because banks don't really have that word.
But then like when you say like owner's equity,
Owner's equity is net worth.
but like you can't change that number.
No,
So then like you
you ignore it.
Okay.
Let's go sit one.
Yes.
I like
If you ignore it, it goes away. M1, M2, and 3. I tell a story where I got uninvited to the top.
Just like I got uninvited from prom.
Devin took a sophomore. Okay. M1. Yeah. Cash, coins, checks,
Here's the bus and
debit cards, traveler's checks.
I think that just happened because you put there for the bus.
Hey, what are we missing from M1?
And 2.
Yes. But hey, is credit cards a money?
No.
Is bonds a money?
Yeah.
Is
Yes. What?
bonds is not a money, and credit cards are not a money, and loans are not a money.
Call them and buy them, and then like on this they have money right there, but they're not money.
What's money?
It's just cash.
It says Treasury bonds, $10,000.
That's not money.
Not money.
That's not money. Can you go buy something at the grocery store with a bond?
No.
So it can't do medium of exchange, which is one of the three functions of money, and it can't do one. It doesn't matter if it can do the other two. It's not money.
Okay. Oh my god.
Okay, M2. Notice how it has M1 in it. M2 also includes savings accounts, business accounts, short-term CDs,
What does it stand for?
certificate of deposits, which is kind of like a savings account, but even lower liquidity. Brianna, turn around. CD is like, okay, so a savings account you can access like 3 times a month, but CDs you can only access it like once every 3 months. Of course, it's going to earn a higher rate of interest, but it has lower liquidity because you can't access it as easily.
And what does CD stand for?
Certificate of deposit.
Thank you.
And so M3 is going to have long-term CDs.
And bonds.
No, because bonds are not money. So bonds would not be in any of the M's because M stands for money. Credit cards aren't here either, nor loans. Long-term CDs, money market accounts, that starts with M. Money market accounts are just really long-term, like for retirement accounts. But
I have to go. I have a dinner appointment for the flesh of bovines and sustenance of invertebrates.
Bye, Justin.
That's steak and shrimp.
I was about to say, so you're eating.
Have a nice day. I missed you.
I missed you too.
He's consuming bovine flesh. I would like that too.
Me too. With
Bovine flesh. Bovine flesh.
yes, with like wheat
You like
patties
bovine?
and then slices of certain vegetables, and with perhaps fermented
Bovine liquids.
yes, in a blue cheese or cheddar format.
Fermented.
Okay, losing it.
Taylor,
Yes.
so in M3, there's only long-term certificate CDs and money market accounts.
And M1 and M2.
How many views you got on your thing?
So far, none.
No, like after you post them on YouTube.
They range about 20.
I'm
gonna watch every one of
them.
That was
Good. You did you watch my live?
I did.
Yeah.
I
Oh,
didn't
Miss
wa- I didn't watch
Taylor.
it last
Do you
time.
remember
I
on
didn't
Friday
watch it.
and you thought it was Dylan? It
Yeah.
was actually me.
Oh
But
really?
I didn't help him.
I was like, hi Dylan.
Yeah, it was
That's
me.
not Dylan.
We thought it was
Okay, let's start off with a recessionary gap on our last page. We can do it. We are going to do some multiple choice questions after this, so stick around. Actually, ignore this. Let's do some multiple choice questions. Wait, this you can do on your own time. There's a key in the back.
No, really.
Yeah, really. I am doing. Hold on. In a 60 question multiple choice part of the test, 10 of them are monetary policy. If you were here on Friday, 10 of the 60 questions are monetary policy. If you were here Friday, I counted and there was 10 over fiscal. That means of a 60 question test, 20 of them.
Which is what percent?
You tell me.
33, 23.
Yes, it's a third. A third is fiscal and monetary policy, which is massive because if you don't know fiscal monetary policy, you will not pass. Very like Gandalf.
Actually, you can get to
You shall not. That's not Gandalf.
You shall not pass. That's
That's
Gandalf.
Gandalf.
Okay.
Let's see what
This is in your era.
or something. Okay, let's look at number 14.
This is in her era.
Did you say it was Dumbledore?
Shut up. Okay.
Shut up.
Okay, number 14. You've got markers and a board. You'll write your answer on the marker board and then raise it in the air. Number 14. Which of the following combinations of fiscal and monetary policy will reduce the price level? A, increasing government spending and buying bonds. B, increasing government spending and selling bonds. C, decreasing government spending and buying bonds. D, decreasing government spending and selling bonds. Or E, decreasing taxes and decreasing the discount rate. This is reducing the price level.
Look at mine. Say mine first.
DJ, let me think, okay?
What's wrong?
Yeah.
I'll reduce the price level,
Right.
Reduce the price level. So they both need to be what? Expansionary or contractionary? They both need to be contractionary. So for fiscal policy, increasing government spending is expansionary. Decreasing taxes is expansionary. So it's either decreasing government spending, buying or selling bonds. Buying, though, is expansionary. Selling is contractionary. It is D. Okay, number 16.
Miss Taylor, so when
Yes.
we're over monetary policy, we always look from like the perspective of the government, right?
You don't do monetary policy. The Federal Reserve does. So when it's like buying and selling, it's them buying and selling, not you buying and selling. Okay, number 16. If the government spending increases at the same time a country's central bank sells bonds on the open market, the interest rate and private investment in plant and equipment, or P&E, capital stock, will most likely change in which of the following ways? Increase, 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 decrease, increase, no change, decrease, decrease, decrease. So they are, government spending is increasing at the same time the central bank sells bonds.
What's a plant?
Okay, so boards down. You know how you and your like non-disclosure agreement on the content on AP tests that you sign, and
then you never.
10 seconds later there's like memes. Okay, so 2 years ago the memes were all about plant and equipment, and everyone had pictures of little plants and then a tractor, and they're all like, plants and equipment, AP College Board, what? Plant and equipment for that year, they've never used it before, is capital. So who's buying the capital would be investment spending.
It's B.
It's B.
Sorry, I didn't mean to say that. Let other people think.
You said it first.
I didn't
Okay.
use it.
I said it first.
What does selling bonds do to the interest rate?
It goes up.
How does government spending increasing change the interest rate?
Crowding out.
Crowding, freaking out.
I know you can say that word.
Oh, yes, you liar.
I wasn't here when y'all talked about it.
Yes, you were.
Were you here with the punch bowl?
No.
Okay,
Yeah.
I was here.
I was
I was
here
here
with the
first,
punch bowl.
and I remember.
I didn't even
Let's
know.
take a
what
measure
punch-
as another.
I didn't even know what
I
pizzas
was
and pizzas were. I wasn't here the whole first 9 weeks.
That's true. I remember.
I learned it all from Mr. Clifford.
It's true. You mispronounced Miss Taylor, but that's okay.
All of them.
Okay.
I watched like 4 hours of Mr. Clifford.
So, Clay, then you should know, because I know Mr. Clifford teaches crowding out, that did you know that when the government increases its spending and spends more than it has, it creates a deficit? And how they fix this deficit is by with the government taking out loans from banks to cover this deficit. If they take out loans from banks, that leaves less supply of loanable funds for the rest of us, which raises the interest rates. So expansionary fiscal policy, which creates deficit spending, raises interest rates 100% of the time, unless the question says interest rates remain stable. Then interest rates remain stable. But that goes up, definitely it's going to increase. Oh, what? Did not. I had to do this. Whoa!
I'm trying to do Just use the thingy book.
Oh, jeez. Oh, God. Oh, jeez.
What do you do?
I didn't press in the X. Cross or whatever.
And then just like, do you know what you do?
Nice. Everything's really loud.
Because the AC went out, so like now.
I think that's why it's
Okay.
really loud.
Children, let's say you don't know what private investment is. Okay. Make an educated guess. And why the heck would it be like a no change? If this is increasing, no. And, oh, interest rates are super high. all the loans don't. No, it's B. Okay, so it's B. I know, I put an arrow through and then I came around. It's B. Number 21. Where's 21?
Keep going.
There we go. Assume that banks hold no excess reserves. A decrease in the reserve requirement ratio will cause total reserves in banks, the money multiplier, and the money supply change in which of the following ways?
Because there's only one answer.
There is literally only one answer for all of these questions.
There's only one
Welcome to
answer.
multiple choice, where they're all wrong except for one.
There's only one answer that decreases the total reserves because you're decreasing the required reserves.
No.
Holds no excess reserve.
Oh, freak. I didn't even get an answer.
She wrote down every single letter.
No, you have to go by column. That's why I do it.
You have to.
A bank that holds no excess reserves and you're decreasing the required reserves ratio.
Ratio.
That means the total reserves would decrease.
Well, no.
No, it doesn't. Okay, let's say that there's $2,000 in required reserves, and excess reserves is 0. Okay, you got it?
Yeah.
There's $2,000 in required reserves, excess reserves is 0. Holds no excess reserves. A decrease in required reserve ratio will cause which of the following? We're going to decrease this ratio from like whatever percent to now. Now you only have to keep $1,000 in excess, and the other $1,000 goes into no change. Total reserves. There's no change. It went
no excess.
which means there's nothing in there. It was all in there. Now there's less in there, and it goes in there. It goes in excess.
It goes in the same place.
It goes away to
Where does it say they're loaning it out?
Just like it disintegrates. Oh, it's in there.
Oh,
It's E.
Wait, I didn't read the rest.
I was like, it's E, right? And she's like, no.
Why did it say?
I don't know.
Miss Taylor.
Okay.
Wait, I might increase if the money's not going anywhere.
What type of policy are they doing? They're lowering the RR. It's expansionary.
Is it expansion? So they're increasing
It's E.
the money supply.
But the
The money's not going anywhere.
It's in excess reserves. They can loan it out,
why this?
and they will.
Why would you buy a sweater with holes in it?
My grandma got it for me, so I didn't buy it.
fashion.
Why would you buy holes in it? That's what I'm confused about.
A sweater's supposed to keep you warm, but then holes make it cold.
No,
so
There are sweater for different weathers.
It's a spring sweater.
There's winter white. There's summer white. This is clearly a summer white, which obviously is going to have holes in it. And when you know, other places exist besides Texas. It's all like, oh, I'm full, so world hunger no longer exists.
Exactly.
Like you can go to like other like
Texas
Number
is
25.
its own country. You should secede.
33.
Texas leaves the Union. Part 2. The South will rise again.
Number 33. An open market operation by a country's central bank to reduce the unemployment rate would be 2. A, sell bonds to decrease the interest rate and increase aggregate demand. B, sell bonds to increase the interest rate and decrease aggregate demand. C, sell bonds to increase the interest rate and increase investment. D, buy bonds to decrease interest rate and decrease in aggregate demand. Or E, buy bonds to increase interest rate and increase aggregate demand.
Texas can run itself. I'm just
I see a range of answers,
Hold up,
ranging from right to wrong.
I'm just trying my hardest.
Oh, wait, just kidding.
Hold up.
You are right.
Give me a wink if it's right.
That was a wink. That was a blink.
That's what you did.
No, I winked.
That was a wink.
Clay.
Never mind.
Are you flinching?
I'm having a seizure. No one knows. I just die right here. So like, Clay, you have a thought. Okay. Open market operation, if they're reducing unemployment, what's the problem here? We're in a recession, so we're going to do expansionary monetary policy. Selling bonds is contractionary.
Decreasing aggregate demand.
Yeah. Oh, we're not in a big enough recession. You don't really know. I love depression. No. Maybe.
I love depression.
You have like. I'm trying to think of like what type of central bank would be like, we love depression. And then I thought of like what a goth, emo Janet Yellen would look like. It's not a phase. Okay.
Man, you
Why was that an answer choice? Helen Keller.
182.
That one test you gave us is like, who's the head of the
It's
like, Helen, Janet.
Kellen.
Helen Yeller.
Helen Yeller.
It's Helen Yeller. The
Every
answer is
time I
Helen
think of
Yeller.
it, I'm like, Helen Yeller.
We saw, what was that, on the
Pretty
government
sure,
test?
Yeah.
It said something about the Federal
And
Reserve.
then
We
we
both
both wrote like Janet Yellen.
Oh
Like
my
really big, and we're sitting across from each other, and I was like,
35. Which of the following results when the Federal Reserve sells bonds to commercial banks? The total assets by commercial banks will eventually increase. The money supply decreases. The discount rate increases. The public increases its cash holdings. The required reserve ratio increases because of decreasing excess reserves.
Now put your boards down, I can't see. Still can't see.
That's not bad.
There you go. Oh. Looks like I'm not doing this wrong.
That's the spirit, Adrian.
That's like.
It's B
Why?
because it's contraction.
oh,
Okay.
I got them backwards.
Jimmy Butler was here.
Tony Butler wasn't here. I didn't teach him.
Well, it says that right here.
Someone wrote that.
You're saying the board lied.
I'm saying Kevin Johnson wrote that.
Yeah, probably.
Yeah. Okay, same handwriting. He also wrote his name right above it in the same
color.
Color.
Also.
Did Jimmy Butler write his name on that board?
And Kevin Johnson, apparently.
39.
The kid that comes in and goes,
Right here. Assume that the United States Central Bank sells government bonds on the open market. How would the sale affect the value of the United States dollar on the foreign exchange market and the United States
Oh.
Okay,
I got it. Don't worry.
what is the,
4x.
Oh, we're good.
I don't
We're
remember
good.
this
We're
one.
fine.
then let me see your answer.
I don't have an
I
answer.
haven't read the question yet.
wait, if they sell it, the money supply decreases, so the value of the dollar would increase. It's
Oh, God.
Hey, boards down, boards down,
No,
boards
I
down.
got it.
No, I'm gonna show you a testing technique, boards down. Let's say you get to this question, you're all like, look at the answer choices. If the value of the dollar increases and it appreciates, what will happen to our exports?
Decrease.
Because things are like it costs too much for foreigners. So like increase it.
Oh my God.
Your point's losing its value. Right?
Hey, Megan.
Hey, it's my trick.
Yeah,
It's my trick.
It's the trick.
It's your trick. It is.
It is my trick.
If the value decreases, we will have increase. So let's leave that. If the value decreases, it's cheaper. The currency is depreciated. You're actually going to have higher exports, not lower. How could it change exports but not the value of the dollar?
Not probably.
That's not possible. So you've narrowed it down to two. Increase, decrease, or decrease, increase. If they sell bonds, what happens to interest rates? They go up. What happens to the money that you could make in the United States on financial investments? So do you think people might want our currency?
Yeah.
And so our currency value would increase and their exports would decrease.
I just thought of it as the money supply would
No.
decrease.
That's incorrect. You accidentally got it right.
So it's A.
It's A.
It's
But you need to be thinking about interest rates before we talk about money
A,
supply.
because interest
Money
rates go
supply and
up.
currency are not the same. You cannot use those words interchangeably.
Wait, so if we said that money supply decreased, which raised interest rates, which therefore people wanted our currency more?
That's correct.
That's correct.
But saying there's more money in circulation or something, the effect of like, I don't even know.
Okay.
We have less money to spend.
No. When the Fed sells bonds, you have to think, oh, that's changing interest rates. Now that's your problem. Interest rates are just higher. How does that affect currency? That's where you put your foot in, Clay. Okay. 39, 47.
Uh-oh.
In the short run, a tight monetary policy tends to cause a decrease in the interest rate and a decrease in prices, a decrease in the interest rate and an increase in private investment, a decrease in prices and an increase in private investment, an increase in the interest rate and an increase in private investment, an increase in the interest rate and a decrease in private investment.
What does it mean by tight?
What does it mean by tight?
I wrote it big.
It is contractionary monetary policy.
Just think of it. I was going to say something, but it's being recorded, so I'm just not going to say it.
Thank you.
So it's good. Can you write it?
Did it have to do with the word?
Oh.
Did it have to do with the word?
I see 2 answer choices, 3 answer choices here that I see. If they're trying to contract the economy, what are they going to do to the interest rates?
They're gonna raise
Raise them. Not increase spending because you're trying to contract it, so you slow down the economy. So it's either D or E. An increase of interest rate, is that going to increase investment spending?
No.
No, it's E.
Foreign investment.
Yeah.
Wait. Wouldn't an increase in interest rate increase foreign investment?
That's not what that says.
Private investment, same thing.
No. Private investment is business spending.
Yeah, exactly.
Not same thing.
Foreign investment and business. Whoa.
Okay, 44. Right there. The demand curve for money shifts to the right when nominal interest rate decreases, nominal GDP increases, real GDP decreases, inflation decreases, the velocity of money increases.
To the right.
Oh,
That's it. Nice.
I'm sure it's this.
I'm real not.
But also, I don't, isn't the velocity money how many times a certain dollar is spent?
Yes,
MV equals P.
I'm going with.
not more dollars though.
Way wrong.
C.
No,
That's right.
it's B.
Oh, I was right.
Yeah.
Okay. You know when you need more money? When you buy more things. And GDP is going up.
When
If it said inflation increases, then D would have been right. If nominal interest rate can't change the demand for money, that would be whatever's on the y-axis can't shift whatever's on the graph. So that's like the only really wrong answer. And if it said real GDP increases, then C would have been right, but B. Hey, Megan.
Who believes that the velocity of money is constant?
Classical economists.
Do we need to know, like, is that like what's
If it's something that I ever mentioned in class, even once, you need to know it.
Right?
Classical
thinks
thinks
it'll just fix itself, and then
Yeah.
intervention,
Yes.
right?
Keynesian believe in intervention, fiscal monetary policy. Classical economists say no, wages are the natural fixer. You don't need to do policy. Just wait. And 48.
Just wait.
It's 450,000.
Okay, 48. After this, we have one more. If the reserve required ratio is 10%, what is the maximum change in money supply from Don's deposit of $50,000 in cash into his checking account?
Ooh. No.
Wow.
I got
That was a guess, by the way.
A gasp?
A guess.
A guess.
I took a guess.
I don't know your board. It's up behind you.
Well, I said it.
I see so many inch choices. It's kind of unbelievable.
Okay, I got with my original guess. Without reading the question.
Ooh, nice.
Okay. Can they loan out all $50,000?
No.
No, so it can't be E.
Right.
Yay, money multiplier. So the money multiplier is 10%, but 90% of 50,000 can be loaned out, which is $4,500. No, $45,000 times 10 is $450,000. So it's D.
I thought that was wrong.
This is money supply. That's just whatever's in excess reserves. So they have to keep a fraction of it of this deposit in required, and the rest of it they can loan out. If it said in the banking system, then it would have been E.
And if it said it was a bond.
And then it would have been the entire amount of the bond.
Okay.
Okay, 60.
Do it. It's
And this is our last one. This is literally the last question on the test. And then you can leave. Which of the following policy actions will directly increase the money supply? The central bank purchases government bonds on the open market. The central bank sells government bonds on the open market. The government increases taxes without changing its spending. The government decreases taxes without changing its spending. The government decreases taxes while simultaneously decreasing its spending.
Increase. Oh, I was trying to.
Central bank? Taylor?
A is correct.
I just need to go.
Oh.
They're buying bonds. Okay, guys, if you could put your markers and erasers and all the boards and stuff up, that would be fantastic. Last day of tutoring is tomorrow. I expect everyone to be there with their shiny faces and their lots of questions. Well, maybe not shiny faces. That's kind of gross. Wash your face.